In our global financial ecosystem, it is vital for us to be cognizant of the various approaches to banking and securitization that are influenced by different national contexts. This presentation will approach securitization and financial derivatives by beginning with what securitization is and how derivatives development works. We will then look at how national contexts influence the securitization of derivatives and how a comparison looks against the United States, US. One foundational component of the securitization of a derivative is an underlying asset. Sahu and Sahu posit that an underlying asset may be the value of an asset, index of an exchange, or interest rate. The derivative's value is based on the changing value of the underlying assets. Sahu and Sahu describe a derivative as a contract between the counterparties which specifies conditions about the date, quantities, and notional amounts, wherein the consideration is settled in terms of the underlying variable, or the transaction settles for loss or gains if it is speculative in nature. According to Baker, derivatives are just financial contracts that in essence are wagers about the future. All types of derivatives are traded on more significant exchanges, with futures and options derivatives traditionally traded on exchanges and swaps being traded over the counter OTC. Clearinghouses manage counterparty credit risk, placing downward pressure on transaction fees by simplifying the distribution of required payments and counterparty oversight throughout each derivative contract period to ensure that clearinghouse members satisfy the terms of each derivative contract. The derivative life cycle, according to Baker, generally includes placement of an order, execution of the order, trade matching, confirmation of trade details, clearing, final settlement, and post-trade clearing and settlement. Derivatives can be used for speculation and hedging. So what is securitization? The two categories of securitization are asset-backed securities, or ABS, and synthetic securitization. According to Delivu, the traditional method of securitization, specifically asset-backed securitization, structures debit securities in tranches where loans are pooled together and then divided based on maturity and risk. Delivu advises that the underlying exposures are transferred off the originator's balance sheets, and investors receive the money that the assets generate. According to Sahu and Sahu, with derivatives, an investor can shift an undesired or excess risk for a price to another who either wants to assume that risk or have risks offsetting that risk. Delivu postulates that synthetic securitization transfers the credit risk of securitized assets without transferring the ownership of them, and the guarantor assumes the risk of the underlying assets without owning the actual securitized assets and makes money by insuring the risk of loss. Unlike traditional securitization, according to Delivu, the assets underlying the synthetic security remain on the originator's balance sheet along with the assets underlying exposures such as a mortgage's default risk. The guarantor receives what amounts to insurance premiums in exchange for contractual payment of any covered loss to the security owner, as exemplified by the German Pfandbrief. A derivative is, according to Norfeld, a financial contract whose value is derived from something else. A long position is where the asset is projected to be owned or is owned by you. A short position is held when you are the short seller, or if an asset is planned to be delivered by you to or by the long position holder. With a long stock position, you have a possible limitless gain and your possible loss can drop to zero. A short stock position offers potential gain and is limited by a price drop to zero, while the possible loss is limitless. With a call option, a call premium is paid by the buyer to purchase the opportunity to purchase the underlying stock at a negotiated price anytime within the option period. And the stock seller is mandated to transfer ownership of the stock when the buyer executes the option. Table 1 offers insight into the basic call option structure where the call premium is $2.50. The underlying asset is Wendy's stock. The price that each share costs if the option holder exercises the option during the contract period is $47 and the contract size is 100 shares. To buy the option, the buyer would need to pay the call premium of $2.50 multiplied by the contract size of 100 shares, which equals $250. To exercise the option prior to the expiration date of the third Friday in September, the buyer would need to pay $47 multiplied by the contract price of 100, totaling $4,700 to the seller. Table 2 provides an example of a long call option where the call premium is $2. The underlying asset is Wendy's stock, the exercise price is $47, and the stock price is $50. when the call option is exercised. The net income for executing the option is the difference between the stock price and the exercise price minus the call premium paid for the option, which is $50 minus $47 minus $2, so the net income equals $1. With a short sale position, you are lent an asset, then vend it at the market rate with a plan to reacquire the asset when market rates are lower for a realized gain of the margin between the sell and the buy prices. Then you give back the asset to the person that lent you the asset. Futures and forwards contracts are markedly different in two ways. Futures contracts are consistent and mandate marking to market. According to C. Shea, marking to market means that the gain or loss from the futures contract is realized daily. Table 3 demonstrates how a futures contract and a marking to market resettlement can work in practice. You buy a 125,000 yen September long position futures contract on November 16th at a $1.20 opening price with a $2,000 initial margin deposit and a $1,500 maintenance margin. You don't remove surplus cash from your margin balance and cover any deficits in your margin account with cash. With the market closing price of 1.203 on November 16th, an increase of 0.003 cents multiplied by the contract amount of 125,000, and you just made $375, which you will see as the first entry in the marking to market column. With the initial deposit in your margin account plus the $375, your margin account total is $2,375. When the market closes on November 17th, the price has dropped to $1.195, resulting in a $1,000 loss, which drops your margin count below the maintenance margin of $1,500, requiring you to add $125 to the account. On November 23, you close out your position at the opening price of $1.189 for a final loss of $1,250, and you remove the remaining amount of $750 from the margin account. In this case, you end up with a total loss of $1,375. Forward contracts are derivatives predominantly utilized worldwide. Foreign exchange forwards are the most widely used forwards and futures derivatives contracts. With a forward contract, the buyer and the seller of the forward contract find out what their actual respective gain or loss is on the maturity date only. The contract size is not fixed. Table 4 examines the basics of how a forward contract develops. You buy a forward contract for 3 million British pounds at a 30-day forward rate of 1.7 Chinese yen per pound. On the maturity date, in 30 days, you are contractually required to deliver 5.1 million yen to the seller, and the seller is contractually required to deliver 3 million pounds to you. In this situation, you hold a long position on the pound or a long pound forward position, and the seller holds a short position on the pound or a short pound forward position. Table 5 describes a forward long sale position where you buy a 6-month long forward contract under the following terms. You buy the contract at the 6-month forward rate of $1.6243 with a contract size of 2 million British pounds. If the spot price, the market price on the maturity date in 6 months is $1.7134, then congratulations, you made a gain of 0.0891 cents per share, multiplied by 2 million shares for a gain of $178,200 US. The gain is not limited if the price at maturity is above the price that you purchased the forward contract, and the loss is not limited if the price at maturity is lower than the contract price. Table 6 reflects an interest rate swap development scenario where Company E plans to borrow $1.5 million to buy into a portfolio with a fixed rate return for 5 years. Company E plans to eliminate interest rate risk by borrowing with a fixed interest rate loan, but the adjustable rate market offers better pricing. Company F plans to borrow $1.5 million to invest in a 5-year adjustable rate yield portfolio and wants to mitigate interest rate risks through matching market rate adjustments with an adjustable rate loan, but the fixed rate market offers a better rate. An interest rate swap reduces debt costs but also facilitates the use of the adjustable or fixed financing that each company wants. The Secured Overnight Financing Rate, SOFR, is an index that changes and is replacing the London Bank Interbank Offered Rate, LIBOR, for interest rate swaps. The rate differential for fixed rate borrowing is 2% higher for company E than company F, but only 1% higher for the adjustable rate loan, making the adjustable rate loan more attractive to company E. Company F would pay 2% less than company E for fixed rate financing, but only 1% less than company E for adjustable rate financing. A mutually beneficial swap can be arranged with company E utilizing the best option by borrowing at the adjustable SOFR plus 2.5% from lender C, paying the swap bank a fixed rate of 12.5% and receiving from the bank a variable rate of SOFR plus 2%. Company F chooses its best opportunity by borrowing at the fixed rate of 11.5% from lender D and pays the swap bank a variable rate of the SOFR plus 1.10% and receives from the bank a fixed rate of 11.25%. Table 7 exemplifies a currency swap development scenario where Corporation A seeks British pounds to fund its business in Wales, but is convinced that the more favorable terms might be available if it issues $40 million in 3-year maturity US dollar bonds at 10%. Corporation A concurrently negotiates a swap of its bond borrowing for pounds at an exchange rate of $1.60 per pound. Corporation A contracts to pay 12% interest on the pounds delivered to it by the bank, and in return, the bank will pay Corporation A's debt service coverage of its dollars obligation. To illustrate distinct approaches to securitization, I have chosen to use the United States, India, and Germany. According to Chi and Young, in the USA, the first commodity derivatives trading began in Chicago at the Chicago Board of Trade in 1949. However, the first financial derivatives trading did not begin until 1972, when the Chicago Mercantile Exchange, CME, began trading futures contracts on 7 foreign currencies. CME constituted the premier authoritative global futures contracts. India is relatively new to the derivatives market, since derivatives have only been available in India since the year 2000. According to Sahu and Sahu, India has the world's largest derivatives exchange, the Indian National Stock Exchange, INSE, and the National Stock Exchange, NSE, which is the leading exchange in India, and provides options and futures contracts on 9 major indices and more than 100 stocks. The rupee against the US dollar represents an elevated exchange rate risk. Germany's centralized, conservative, and risk-averse regulatory approach to derivatives is exemplified by the strong support for the synthetic derivatives mortgage Pfandbriefs. As part of the European Union, EU, Germany has escaped being exposed to currency rate risk from trade with other EU countries. However, the exit of the United Kingdom from the EU, Brexit, and the possible dissolution of the EU will expose German citizens to additional currencies and currency rate shocks requiring derivative currency rate risk hedging. Brexit also creates concern for questions of enforceability of unclear derivative contracts between Britain and German-based entities. Some of the similarities in securities construction between the US, India, and Germany are that larger sized companies are more likely to use derivatives than medium or small sized companies. Asset-backed securities remain popular in each country even after securitization was blamed for the global financial crisis. Entities in all 3 countries use derivatives to lower risk. Firms reduce cash flow risk, profitability, volatility, and stock return risk substantially via financial risk management with derivatives. The use of derivatives promotes capital expenditures investments. Each country uses derivatives to reduce external debt financial costs, with lower firm risk potentially indicating that hedging with financial derivatives reduces a firm's cost of capital and thus the economic profitability of the firm. All 3 countries domicile companies whose use of derivatives for hedging seem to acknowledge, as Norfield points out. A company that does not have any hedges for its market price exposure is effectively gambling, speculating that future price moves will not damage its business. Each country shares the derivative construction that utilization of the options contracts will reduce exposure to risk, also limits exposure to gains. When we look at the similarities in the construction of derivatives for all 3 countries, we can view what each country shares in common involving options. They all use contracts to trade. The buyer has the option to buy and the seller has the option to choose to sell the option. If the buyer chooses to buy, then the seller is required to sell. Each option has an exercise or strike price in each contract, and the option premium is paid by the buyer of the option. Each options contract is also set at 100 options per contract. The similarities continue with swaps, as Baker explains that in more significant markets, OTC derivatives, swaps, include interest rate derivatives, foreign exchange derivatives, commodity derivatives, equity derivatives, and a miscellaneous category. Finally, they all share the element that the value of the derivative can be based on virtually limitless possibilities from platinum prices, securitized financial instruments, weather variables, or derivative contracts, etc. And interest rate swaps can be used to hedge variable rate debt into fixed rate debt. You will recall synthetic securitization as one of two securitization methods from the earlier slide. Another difference is that in 2007, synthetic securitization ceased in the US but remains popular in Germany. From a user perspective, US users utilize derivatives for hedging and speculation, which can inject additional risk into the financial and banking system, while companies in India use derivatives primarily for risk management as opposed to speculation. The date that a call or put option can be exercised also differs between the US, India, and Germany. For call and put options on US contracts, the option must be exercised anytime within the agreement period. For call and put options on Indian and European contracts, the option can be exercised on the maturity date only. Another deviation from both US and German securities construction versus Indian construction involves active insider trading by Indians who have information on mergers and acquisitions, M&A activities, and are able to use this information to buy derivatives with strike dates that are close to or match the dates when the M&A transaction of their business will close. In the US, the US Federal Reserve, Treasury and Securities and Exchange Commission issue regulations that affect the creation, required disclosures, use, and distribution of US securities and derivatives. According to Norfield, the US Commodity Futures Trading Commission is, quote, in charge of regulating futures markets, unquote. According to Kota and Chiramuthi, to provide accounting standards for derivatives, the Financial Accounting Standards Board, FASB, of the United States has issued FASB 133 and 137 and FAS 161. Reforms in the US are aimed mainly at procedures within banks, while in India, Kota and Chiramuthi advised that the Ministry of Corporate Affairs merged Indian Accounting Standards, INDAS, with International Financial Reporting Standards, IFRS, yielding Financial Instruments Standards, INDAS 32, 109, and 107, that defines, recognizes, measures, and specifies disclosure norms of financial instruments, including financial derivatives, were introduced. In Germany, according to a regulatory agency, BAFIN oversees German securities, banking, and insurance, and ensures the German financial system's stability and integrity. Additional levels of regulation are generated by Delavu asserts the Basel Commission on Banking Supervision, BCBS, the International Organization of Securities Commissions, and the European Banking Association, EBA. Regulation of securities in Germany follow the European General Systemic Convergence methodology. Table 8 reflects, as C. describes, an insurance put, which is one long put plus one long stock. In an insurance put, usually you have the long stock position first. At some point after you purchase the stock, you are afraid that the stock price may go down, but you are not ready to sell the stock for reasons such as deferring income taxes, maintaining voting rights, among others. In this situation, you can add a long put position to reduce the downside risk. In the example, for any stock price below $54, which equals K, the total gain is locked in at $2. Table 9 shows another possibility, which according to C. Shea is a covered call, where you have one long stock plus one short call. Normally you buy the stock and sell the call at the same price. The strike price is higher than the stock purchase price, so the call is out of the money. You can choose the strike price equal to the stock price at which you plan to sell the stock. If the option becomes in the money and the stock is called away, you plan to sell the stock at that price anyway, and the call price that you received is an additional income to you. If the call expires out of the money, you simply keep the premium. In this strategy, the loss is limited, although it is reduced by the call premium, but the gain is capped at the point where the stock price reaches the strike price. Table 10 describes, according to C. Shea, a straddle strategy where you are buying volatility, and it is structured with one long call plus one long put. The call and the put have the same underlying stock, strike price, and time to expiration. Assume that they have the same premiums. Normally, their prices are slightly different. The stock price must rise above K plus C plus P, which equals $50 plus $2 plus $2, which equals $54, or fall below K minus C plus P, which equals $50 minus $2, which equals $46. For this strategy, it should become profitable. There would be a loss if the stock price stays within these two prices. The maximum loss occurs at the strike price K. This strategy is used if there is an event coming up for the company and the stock price is likely to react to it violently, either up or down, depending on whether the event is favorable or not. A large swing in the stock price is needed for this strategy to be profitable. Table 11 demonstrates a strategy referred according to Shea as a call spread, which is one long call plus one short call. Both calls have the same underlying assets and time to expiration. The strike price for the short call, K2, is higher than that of the long call, K1. You buy a call option to bet on the increase in stock price. You also short an out-of-the-money call to receive the premium to reduce the cost of the long call. Therefore, the strike price of the short call is higher than that of the long one. However, the gain is capped when the stock price reaches the strike price of the short call. C. Shea describes a naked call as a short call that is not coupled with any other position. As shown earlier, a short call has limited gain and unlimited loss. To avoid the loss, the strike price is chosen such that it is significantly higher than the current stock price. That is, the call is deep out of the money. The seller of the option hopes that the call will stay out of the money through its entire life, such that he gets to keep the premium as a gain. Per C. Shea, a naked put is a short put that is not coupled with any other position. As shown earlier, a short put has limited gain and unlimited loss. To avoid the loss, the strike price is chosen such that it is significantly lower than the current stock prices. That is, the put is deep out of the money. You, as the seller of the option, hope that the put will stay out of the money through its entire life such that you get to keep the premium as a gain. However, you also are willing to buy the underlying stock at the exercise price if the option expires in the money. You choose a strike price at which you believe the stock will bottom out, such as if the option is exercised. You end up buying the stock at the bottom. I hope that this information will be helpful moving forward so that you will have better insight into our corporate derivatives strategy. As you can see, with a financial services company the size of ours, that we have both resources and need for derivatives to hedge our exposure to interest rate risk, currency exchange risk, and the benefits of having a broad derivatives menu to choose from to protect shareholder value. Thank you, and please contact me by email if you have any questions about derivatives and their effective deployment.